Hello there. So in this video, I'm going to be talking about the series Let's Talk Money, but I'm not going to be building on the derivatives issue that we were discussing in the previous video, that is episode 6. In this episode, I'm going to be talking about investing in an emerging market compared to investing in an emerged market. You see, there's a difference between investing in an emerging market and investing in an emerged market, because investing in an emerging market is like investing at the beginning of a boom, while investing in an emerged market is like investing at the middle or at the tip of a boom. And given the location difference of an emerging market and an emerged market, the returns are different, the expectations are different, the overall investment infrastructure is different. For an emerging market that is like Africa in this given point in time, Africa is an emerging market. All African countries are emerging, provide an emerging market, and this emerging market, it is both visible in terms of the stock performance, that is the price per share of which company in the emerging market. It is visible in the rate of capitalism and entrepreneurship, the rate of product innovation, product invention, the rate of service innovation, service invention. All these aspects are able, if you look at all these aspects, you are able to see that you are engaged in an emerging market. Now, what are some of the benefits of being part of an emerging market? Well, for me, because I'm part of an emerging market, that is the Kenyan emerging market at this given point in time, that is 2020. The beauty of being a part of an emerging market is you get to have a low barrier of entry. And by this I mean, for example, if you wanted to buy a share for a company, a big company in Kenya right now, you get to buy that share at a relatively cheaper price. The price is so cheap, you can buy as many as you want with as little as a fraction of the money you would have purchased the same shares, the same quantity of shares in an emerging market. And that's a very good advantage for an investor who is thinking long term, because for an emerging market, the objective is to be emerged, and given that an emerging market is aiming at being emerged, being for example, let me use in terms of classes. There's the first world countries, there's the second world countries, the third world countries. So most African countries which are emerging markets are considered third world countries. And for a country that is considered a third world country, the objective is to rise up the scale into being the first world country. And in that process of growing, in that process of rising, in that process of developing, every aspect of that emerging market grows with it. There is the real estate aspect of it, there is the stock market aspect of it, the business aspect of it, the entrepreneurship aspect of it, the employment aspect of it, the amount of jobs aspect of it. Every aspect grows with it. Now, at this point in time, we are in Kenya is in an emerging process, and we've just come from an election, and the election has been peaceful and has been productive, in that at the end of the process we have a leader who is going to take us for the next 5 years. And in my presupposition, in my presumption, I expect this leader, that is His Excellency Honorable William Ruto, who is the president-elect at this point in time, after he is sworn in as the president, I expect that we would want not just to do one term, but 2 terms. And so in that expectation, expect in his first term, which is this term, I expect him to perform with utmost excellence in terms of execution, planning, in terms of consideration, in terms of strategizing, productivity, every aspect of a well-functioning government. I expect it from this current government, because in my view, I see to it as the goal is to do the best that they can be able to do, so that to have a better advantage in seeking for a second term in office. And in this doing the best that they can be able to do in the first term, there are some of the opportunities for you and me, the typical citizen who is not sitting in a position of power, political power, that is. There is opportunities for you. For example, one of those opportunities, let me just mention one for this video. Right now, the price of products in the stock market, that is the price of shares in the stock market, is, in my opinion, undervalued. And it being undervalued is not necessarily a bad thing for you and me, because it being undervalued is giving a typical citizen the opportunity to be an owner. And ownership is a big thing. Ownership is something what's the word? It's something worthwhile. Yeah, it's something really inspirational, being an owner, because everyone grows up. Everyone is born with nothing, and from after being born with nothing, you start accumulating things. Some you accumulate from inheriting from your parents, some you accumulate from creating from scratch, some you work for, some you get gifted. It's a process of accumulation. Now, if you were to accumulate ownership in terms of companies, you own company X, company Y at a given ratio, with a certain amount of shares, a certain amount of amount of shares in this company, that company. This kind of ownership gives you the skin in the game, in that if the economy was to perform in the best possible way, if the government was to bring out the best of the economy and was to revive the economy, your exposure to the economy, that is through the ownership of the companies participating in the economy, that exposure you have in the economy is going to work to your benefit, because now you have taken the risk and you have put your money in certain companies, and those companies have given you ownership rights to their companies. And if the economy was to revive and was to grow back into being a growing, booming economy, you would also have a share in the profit. You also have a share in the growth, regardless of whatever. And remember, this is investing, first of all, in shares. My philosophy is buy and forget, because that way you regulate your expectation. But before you buy, you have to be clear on what the expectation is, because in as much as you're regulating the expectation, that doesn't warrant you to not have any expectation, because it is in that expectation that you have initially that is able to guide your decision of who to buy, when and why, and for how long, because you have a clear expectation. And once you've set out to define what expectations you have or you ought to be having, it is advisable for you to look at what are the goals, what are the aspirations you're aiming for. Why would you want to own? Is it because you want it to be is it because you want it to be a source of wealth for your generation, that is your kids? Or is it because you want it to be your source of wealth? Or is it because you want to own because you can own? There's so many reasons as to why you would want to be an owner. Because remember, in as much as being an owner is beneficial, it is also not beneficial, in the sense that if things were to go wrong and the economy was to go the other side, you would also have a pinch. You'll also feel the pinch of the economy falling, because you are exposed to the economy through the ownership. So ownership is it's a double-edged sword. It cuts on both sides. It cuts on the benefit side, that is, it gives you the opportunity to earn from a growth in the economy. It also gives you the exposure to feel the pinch from a fall in the economy. And given there is that self-sustaining aspect of it, where when it goes up, you go up, when it goes down, you go down. That self-sustaining aspect of it is what brings together, is what makes the whole thing sustainable, because it is self-sustaining. And that's what gives you the opportunity to make the most out of it, but for you to make the most out of it, you should be able to understand how it is self-sustaining itself. What are some of the factors that constitutes a boom, and what are some of the factors that constitutes a fall? And if you were to look at the list of factors that constitute a boom and to arrange them in this side, the list of factors that constitutes a fall, arrange them in this side, and in a way, this will be your pros, this will be your cons. If you were to weigh the pros and cons, if the pros are heavier than the cons, then the chances that it will be a boom is higher than the chances that it will be a fall. But if the cons are heavier than the pros, the chances that it will be a fall is higher than the chances that it will be a boom. And this is an objective view of investment, because it is an objective because it takes out the emotional aspect of investing. You're not investing because you feel like this is the right investment, because feeling is an unsustainable aspect of being a human being. It keeps on flipping. Right now it is good, the next minute is bad, the next minute is good, bad. It keeps on flipping. It is not sustainable, it is not reliable. So if you're basing your investment decision based on your feelings, the sustainability and reliability of the investment would be under question, because it is being based on an unsustainable, unreliable basis. But if you are basing your investment decision based on objectivity, you look at things as they are, not as the way you would wish them to be. You look at them as they are, and you evaluate them based on the features they have, the characteristics that they portray. And if the characteristics are appealing, you make the most out of it. If they're not appealing, you stay out of it. And in a way, you are objectively aligning yourself. Of course, you can't say that you are able to live a life without making mistakes. That's delusional. Making mistakes is part of living, but making mistakes in a way that you don't see them as a mistake is now a problem, because now you are you'd be having the wrong lens. You'll be wearing the wrong lens, and you'll be seeing the issues in the same way, and you'd be manifesting the same problem over and over again. Why? Because you're basing your decision on the wrong thing. Think of it as like research. For you to do good research, you have to define the problem well. What problem are you actually researching? And if you don't define the problem, regardless of whatever you do below that, regardless of the solution you come up with, it will be invalid, because the problem in which you are solving the solution is poorly defined. So regardless of how good the solution looks, it first starts with defining the problem, then going after the solution. In the same way, in investing, it first starts with defining the expectations, the objectivity in the expectation. What is the objective? What is the goal? And then after that, the answer to that question is now valid, or probably has a higher chance of being valid, because it is being based on the right question. And this is some of the investment knowledge that I think is worth sharing, because for me, if I had known this while I was starting my investment, I would have probably not sold my first shares that I bought. That was the shares I bought at Crown Paints. I wouldn't have sold them, because I would have known I'm not buying them to sell in the next 2 months, 3 months. I'm buying them for the long haul. And by now, I would have doubled my investment by 100%. In fact, I'm not even doubling it. I would have had my investments by 100%, and that means I would have doubled my money. And looking back to that decision, if I had asked myself, what is the expectation of me buying this stock? And I would have honestly answered the expectation, and I've structured a very logical and objective expectation. I probably would have not sold the shares too soon, because the expectation would have been the barrier that is not allowing me to make that emotional decision. And now looking back, I think it is very important for every investor to look at the expectation and to be clear on what the objective is. And for now, in this video, I'd like to publicly declare an expectation that I have, so that you can have an idea of what an expectation looks like, so that if you have your own expectation, you can compare it with the expectations you've had online from people like me, who are telling you the expectation for free online. It's not easy to find such kind of people. Most investors would charge you for such kind of information, but not me. I'm a nice one. So what my expectation is this. Right now, we're in a transitional position from one government administration to another government administration. That is, we're transitioning from the government administration of His Excellency President Uhuru Kenyatta and transitioning into the government administration of His Excellency Honorable William Ruto. And in this transition, some of the things that you would objectively expect is that the transition would, the change in the philosophy of leadership, that is, would be in a way of adding on the would be building on the successes of the previous administration, learning from the mistakes of the previous administration, and looking to make new growth. And also, given that the current president, who is the president-elect, given that he has a bottom-up vision of what his government administration is aiming at, redefining how the government is structured in terms of execution into a bottom-up sort of structure. The way that I would expect it to play out is in a sort of empowerment way, such that those at the bottom of the food chain, that is students, that is people in school, that kids in school, that is people who are just getting out of school, the graduates, the interns, those at the bottom of the food chain would be empowered, and this would increase productivity. And given that, I also would expect that the current president-elect would also vie for the next term to have 2 terms in office. I expect that. And given that I expect that, I also expect that for him to, because I know he's a very strategic and a very ambitious leader, very disciplined, very objective. You can decipher that from a person based on the actions they've been doing. Think of the campaign he ran. Think of the things he's been through in terms of looking back. Some of the expectations you have is you would want to have 2 terms in office, and that is logical if you ask anyone, because of there's no need for a reason. It is logical to expect that. The first term in office would be that kind of a term that is purely meant to work and revive the economy. And in so doing, the economy is going to experience a sort of growth or development, because the leaders that are running the economy, that is the administration that is leading the economy, are ambitious, looking at 10 years ahead. And that gives the economy room for growth, room for development, room for reconfiguration. And that is an expectation of mine that I have. I expect the current administration to be looking 10 years ahead, because they would want to do a 2-term in office. And given that I expect that, I also would structure my investment decisions around picking the companies that I think would be crucial in the reconfiguration of the economy. The sort of companies that a country needs in order to be able to grow and develop. And I know by saying that, I have probably filtered through a lot of companies, because once you ask yourself, what company does the government need in order to reconfigure the economy? Then the next question to be able to narrow it even closer would be, which industry does this company belong to, that is an industry that is crucial for the reconfiguration of an economy. And just out of the blues, my expectation would be the energy industry, because currently we are having an energy crisis in terms of petroleum from Russia. And I don't know exactly how they go about reconfiguring the economy. I don't know how exactly they'd go about executing their plan, the bottom up plan. But what I do know is there are certain companies they would need to be functioning at optimal for them to be able to have the capacity to reconfigure and develop an emerging market. And I'm not going to mention any company's name, that is if you're expecting me to mention one. But if you'd want to hear one from me, you can just comment in the section below. Maybe even follow me on Twitter, ask me on the DMs. But that is on a personal sense, because that is opinionated. That is not factual in the sense that it is the truth and nothing but the truth. It is an opinion. It is a perspective. But given the questions that I'm basing this perspective, this opinion on, you can see the objectivity in it, because I'm not saying I feel like this is what will happen, because my feelings are not a valid basis to make a decision, but rather my thoughts and my logical objective expectation. That is a good basis to put a decision on, because it is more more reasonable than not. Yeah. So I'm not sure whether this video has been helpful, or as it has been something you'd have wanted to hear, or it has been productive in terms of your time you've spent watching it. And the only way I would be sure of that is if you reacted to the video. Let's say you liked it or disliked it or commented in it or subscribed or hit the notification bell. It's until you do that I'm able to be sure that I helped you. So how about doing something, just anything? There are so many buttons in this screen down below here. React to this video. Tell me something you think about it. Tell me something you disagree with it. Something within it that you disagree about. Something within it that you agree about. And I'll respond and I'll share it to you. So this is Let's Talk Money, and it's majorly about expectation and how to objectively expect, and what an objective expectation might look like, in my opinion. Stay tuned. There's more to come, better than this one, maybe even the one that you've been expecting the whole time. Stay tuned. See you soon.